episode 32. What's up, Vic? How you doing?
I'm doing pretty well. I was in Chicago the last couple of days. It is cold in Chicago. Happy to be back in Nashville.
Already super cold?
It is super cold. I thought I'd walk to dinner, I guess 2 nights ago, and I walked outside the hotel, and then I walked, well, the hotel restaurant will be fine. You know, it's too damn cold. To walk around, so.
I spent a lot of time in Chicago this year, and it was all like September.
Yeah.
I mean, it's such a beautiful city if you can get there before it gets cold.
Yeah.
It's so beautiful.
Scheduling a board meeting in December probably wasn't the smartest thing, but
yeah, you probably could have done that one by Zoom.
Yes, exactly.
In the future, just plan your trips for the summer.
Yeah.
You know,
yeah.
Plan your trips for the summer. No more beautiful city in America than Chicago in the summer.
Yeah.
I mean, it's just gorgeous. All right, look, we are heading into the holidays. We are, getting some end of year financial news that's kind of going to set up how we're feeling about 2024. Mm-hmm. And, I'm kind of happy with where things are landing right now. It feels like a little bit of a relief. But you ready to dig in?
Yeah. All
right, let's do it. All right, so let's start with the Consumer Price Index, rolled out Tuesday, December 12th. What can you tell us about it, Vic?
Kind of the same story. There was a small increase, 0.1% in November, basically a 3.1% annualized rate. Very similar to what it has been kind of trending at. Not a big change, pretty much as expected. So not a lot of new things there. Good to have it, not go up.
Yep.
I think it's benefited a lot from the price of energy coming down. But no, we have a chart just to show, we've been showing it before. So for people that are listening, this goes back, well, I can't really tell, but it goes back 12, longer than that, I think. So this goes way back to like before the great financial crisis. And for people that are listening at home, it, pretty much sits between 0% inflation and 4 maybe.
Yeah.
And then in the pandemic, it spiked to 9 or something, really high peak. And then as we've been covering on the show, it's come down pretty dramatically at 3 right now. That's not 2 where the Fed wants it, but, much lower than it was a year ago.
Yeah, and almost no one, I think, believes we're going to get back to 2. I mean, Jerome Powell keeps saying 2.
Yeah.
But I don't hear a lot of people that believes that we're going to get back to 2% inflation.
Yeah, I don't know. I mean, I'm more worried about deflation than I am inflation right now. So I think we could go down. I mean, after the shelter kind of runs through, which will happen in the first half of the year. So by next summer, that'll be gone. We covered that maybe a couple of shows ago. I think that we're going to have a significant reduction in inflation, but that could be wrong. It depends how the markets, how the Fed behaves and how markets go. But I'm more nervous about the downside to inflation than it going up again.
But you do have to admit that probably the betting odds of a Goldilocks situation are improving.
Yeah,
every week, and that's kind of unbelievable. Yeah. I mean, credit to the U.S. economy, and look, credit to the Fed for like raising rates and making it really ugly for us VCs, and but somehow the stock market. Well, we know how, because all of it's aggregated in big tech, so we know how the stock markets continue to grow. But even crypto rebounded.
Yeah. I mean, I think that listen, it's a Christmas holiday. Or, with end of year, it's good to have everyone happy going into the end of the year.
Mortgage rates are dropping?
Yeah. Yeah. So, I mean, I think let's maybe go to the, so that was Wednesday, I think, and then the Fed came out, no, maybe Tuesday, and the Fed came out Wednesday.
Right.
And I think the general outlook from the Fed was sort of a Goldilocks positioning, where they were talking about things are getting much better, inflation easing, words like that. They didn't make any policy change, but it was much more friendly to Wall Street. It was a Goldilocks kind of press conference, which is great. And I'm hopeful. I think it's important to say the Fed has never executed a soft landing. And so I'm hopeful. It seems like they've done a great job sort of pushing the economy to under some pressure, reduce inflation. I think inflation was probably coming down a little bit on its own, and they helped it. There's a good chance that they could pull off a soft landing, which would be wonderful.
Yeah. Janet Yellen said that inflation was making a lot of meaningful progress. Fed says Powell said that the Fed is at the beginning of their policy easing talks. I mean, the fact that he said we're even using the word easing.
Yeah. They're still doing QT, but they are talking about when they will ease, how they would ease, talking about easing the rate environment, which is great. I mean, I agree completely. The fact that they are talking about that is really positive.
It's the first time in a year and a half.
Yeah, exactly.
That we've heard anything like that.
Yeah, and then everyone was talking about this dot plot thing.
Yeah,
so we need to talk about what the dot plot is and why anyone cares. And so all the voting members of the committee are asked to put their guess of what the future rates will be. And then that is published as a dot plot. And so I think everyone was excited that the dots on the dot plot are coming down. And so that
on average by 75 basis points.
Yeah, next year, if you take the average of everybody, and they don't all have equal voting power,
right?
But it's the best we have right now. Yeah, the projection is that they would cut 75 basis points next year.
Yeah, so kind of 25 basis points in across 3 different cuts.
Yeah. So I mean, maybe pull up the dot plot itself. We can talk through it. It's for 2023, no one thinks it's changing, of course, but then. One, I think they're all guys. One of the members has it under 4 end of the year. Super aggressive.
Yeah, that's really aggressive. Two had it holding.
2 had it holding.
Still. One had one very small 25 basis point cut. But the majority saw it coming below 5%. So the majority see 2 or 3 cuts.
Yeah, right. Yeah, and then in the longer term, they want to get the rates down, back to the 2 to 3%.
Yep.
So like as they go out in the future, they sort of come down and down and down. So anyway, that the stock market celebrated. I think everything was up to big highs immediately after the press conference, and so I think it's good. Whether they have executed the soft landing perfectly, or it gets a little bit bumpy, and we have a recession in the first half of the year. I don't know that I'm ready to say one way or the other, but definitely yesterday was a good move on the Fed's part.
So let's just riff a little bit on this.
Yeah.
I mean, where do you think our industry of venture capital ends up next year? I mean, because the dislocation that we've seen as an industry this year, I actually think it's way more severe than so many industries, right? There's been a lot of talk about corporate real estate, but there hasn't been a lot of like fallout yet.
Yeah,
there's been a lot of strong hands just kind of hanging in there. A couple of leases here and there, sort of handed back to the bank, but for the most part, not really yet.
Yeah.
Not
it hasn't
yet.
really hit yet. Right.
Yeah. Construction capital has basically stopped seemingly everywhere but Nashville. It's still building here. But mostly construction capital has stopped. But gosh, in our space, I mean, so many companies gone, so many funds not raised.
We were talking earlier.
Shutting down.
There's a whole bunch of pretty aggressive, highly structured, complex deals trying to get done before the end of the year because companies are running out of money.
Right.
And I don't know they're not all going to get funded. There's still companies that are going to fail or about to fail in the next 3 months.
Right. And the fallout from that is going to be poor performance in vintages, right? Which is going to lead to LP scrutiny and just a rebalancing of the overall allocation strategy.
Yeah.
Right. We got a Bitcoin ETF that's likely going to land in January.
And the halving.
Yeah.
So, I'm outside of healthcare. I follow crypto. You do too. I think Bitcoin's going to be up a lot next year.
Yeah. So okay, back, and then you have AI, which is layering in this threat of dramatically lowering the cost to bring innovation to market.
Yep.
Right. That plus the fact that Elon has somehow made X into a far more robust product with like a tenth of the human capital.
Yeah, I listened to my first full Spaces maybe 2 nights ago, and it's pretty good. It's a good platform, high quality. I don't know. It's a good alternative to the basic media that is all the same shit.
Yeah. So where do you think that lands? I'll tell you, I still feel good about the seed stage. I think the seed stage is a very viable stage in terms of the entry points, meaning, the price of the equity. It's reasonable. You can do the math, right? It's not $400 million at a $4 billion value.
Right.
And then you got to create a $20 billion company to make it make sense. It's not that, right? Our valuations are, generally speaking, 20 million or below. We don't have to cut super large checks. And it's reasonable to create enough value to get to, a $250 million exit sort of in a 10-year time frame and create a nice return.
I'll invest in that.
Yeah. So
I'm biased, but I agree with that.
That still feels viable, right?
Yeah. I think my view, which of course, we're two seed investors talking to each other.
Yeah. No,
how great the seed investment is.
Well, but I'm literally asking you because
I have 2 things I want to talk through about the venture market. So,
okay.
And again, the first one is my biases may be coming out, but I think that it is true that the world, but certainly the healthcare industry, needs innovation to be created and then brought to market. And the seed is the first significant institutional investor there. There aren't many companies that don't have a seed investor. So I think the seed market has to be in place. Now, whether we get the chance to continue to do that or not, we have to perform, right? But there will be seed investors always, I think. As you get up the stack and you do A, B, growth equity, and then sort of later than growth, I don't know that I would say that's required. It just depends on how you build the business, how the model is, when the public markets are open, what your goals are. So that's my view of where seed fits in the venture capital markets. So I like our position. It's also, though, hard.
It's very hard. It's risky.
Yeah, it's risky.
There's not a lot of revenue, so people don't take you very seriously.
It's risky. There's a lot of failure. There's not a lot of revenue, so people don't take it seriously. But the real issue is the funds are small.
Yep.
Just because you can't deploy that much money. And then that means the overhead has to be kept low.
Yep.
And, both of our wives would be happier if we had bigger funds. We wouldn't have as safe of a position in the market, but that's the trade-off, I think, is that I can't imagine deploying $3 billion in healthcare seed. It just wouldn't.
No.
You can't put enough money in those companies to do it. So that's sort of the trade It's a trade-off maybe there.
But okay, but we do have a challenge, which is that our business used to be based really on the milestone of graduating a company into later stages.
Yeah.
And it seems like the later stages are so screwed up now that I just don't trust the later stages to be a functional next step for our companies. I mean, we've talked about this in past episodes, but when I look out to 2024, I'm not thinking about our companies graduating to, Series A and Series B broadly. There are a couple of cases where they've got great investors that are surrounding them, and they're gonna get there. Like, I know that right now. But in a lot of cases, I'm thinking, I need to be the capital partner. I need to continue to support them, and they got to grow revenue, and we got to make sure we're putting the right people in the right seats, and they're executing, and they're, getting as close to 100% growth rate as possible on execution.
Yeah.
Right. On execution and product market fit. It just doesn't feel like. It feels like it's going to be a long time before we're flush with capital again, and part of the growth is related to graduating to the next fundraising round. Like, it feels like it's going to be much more P&L focused, which is, at the end of the day, like, that is a shift. That's a fundamental operating shift. I think it means the portfolio management work is more significant, because a lot of people may not understand this, but let's say you're us and you're a seed stage investor, and you get the company graduated to Series A. Okay, well, the Series A investors coming on the board, and they kind of take over. I mean, you're still there, you have a say, but they've written a bigger check than you, and they're planning on writing more bigger checks in the later rounds. And so it's not that your work is done, but the burden of portfolio management decreases. Whereas if you are continuing to be that capital partner and really be the key value creation partner, it's more work. It's more time. It's more work.
There's no question about that. And I think it's, it leads to the next part I wanted to talk about, which is I have this thesis that I want to get your thoughts on. We haven't talked about this before, so we'll just do it live, which is probably good. So I think that the venture capital assets, right? So our assets, and in general,
the asset class,
I think it is late to the party. I mean, public markets react first.
Yep.
And multiples come down very quickly. And then it kind of flows through the private markets in order of sort of the inverse order of how the company takes the investment. So like the people that invest just before an IPO take the next hit, then it's a growth, then later stage venture, seed is the last to really see the effect. So the correction was probably a year ago, maybe a little over a year ago in public markets. November, I think. I can't totally remember it. A long time ago, there was a public market correction. And we are feeling it like today. I think the Q4 valuations are going to be significantly down in venture. Might even be Q1 next year. And so it's lagged. It's like this slow moving process. The image I have is like a whip, because I think it's like called the bullwhip effect in supply chain, where the public markets come down quickly, and then we take a lot longer to come down. But I think we go further. Like I think it's more impactful. Like there will be companies in our stage that just don't exist anymore,
right?
And public companies, they take a hit in a multiple, but they have more girth to them.
Yeah.
And then I think the opposite happens, where like the public market will come back faster, and then our space will be the last.
Comes back slower.
But it comes back it's much more bubbly. It will come back much higher. So I think our asset class is significantly lagged, and also 2, 3, 4 times as volatile, which is, I've been just thinking about that over the last month and trying to map it to my portfolio management strategy. Right. So like there's going to be a time when the whip effect is back really high, and the multiples are high and flush with cash. People are raising huge rounds. And I think I want to be positioned to sell into that. So I'm just trying to map this. Both the timing is the hardest thing to get, but it feels like that's the order. It kind of go. You can watch the public markets. Probably yesterday might be the start of the next sort of uptick. Maybe there'll be more corrections, and then it will sort of flow through the capital markets roughly in order until we're last.
But isn't there also like a bit of a prestige knock that's going to be a little bit harder to shake? I mean, did you see what happened with Bird, the scooter company?
No, I didn't see it.
Okay, so Bird was, I think, the fastest unicorn in the history of the market.
Yes, I think they were.
They were delisted.
Wow.
And they're now worth like $7 million. And the headline I saw on X was that they're now worth less than the $22 million mansion that the founder bought.
Yeah.
With the money that he earned from growing the company into a unicorn faster than anyone else, right? And it just feels like post-ZERP, post-COVID, post-SVB, right? People are just getting much more oriented and focused around fundamentals and are just smarter about these propped up companies that are really valued based on hype and narrative and not based on any P&L fundamentals, so to speak of. It just feels like people get that more now. And that unfortunately the entire venture space gets painted around that. Even though we're based in Nashville, Tennessee, let's just round up and say Tennessee represents 1% of all venture capital in the United States. I don't think it's 1%, but we'll just round up to 1%. That's certainly not the way that venture capitalists in Tennessee have been operating because
in healthcare, really.
Yeah, because they have not had access to that kind of capital. To be able to operate that way. So they've had to be much more focused on building viable companies, that actually produce and are, generating EBITDA and things of that nature. But unfortunately, the whole asset class gets painted around these stories, around these flame out stories, or around WeWork, or around, any of the 2021 stories. I mean, I just had a conversation an hour ago about Olive and the $800 million that they raised in a year. And, you're trying to wrap your head around any industry that would allow $800 million in capital to go into a company in a year, and 2 years later, that company is vanished. There's something not quite right about that industry. Right. And like you and I, we kind of look at it as, there's something not right about those players in the industry. Right. But not everyone is dialed in enough to sort of be able to suss out.
Who's who,
who's who and what's what. So I do feel that there is a bit of a prestige knock that VC broadly is getting. And I think that's going to be another headwind going forward. Unfortunately, I mean,
maybe I don't agree with that. I think that my view is people have short memories. So I hope
you're right.
My belief is that today everyone is worried about their mortgage payment or their credit card bill or their job or their neighbor's job. Everyone's concerned about the possibility of a recession early next year.
Right.
And that's because the Fed just put the brakes on everything and made us all focus on that. That was their intent, I think. But I think as soon as the Fed relents and they do 75 basis points next year, and then they do another 50, there's going to be some new exciting thing. It won't be scooters this time.
But risk on, basically.
It'll be risk on. And I think there will be some folks that are slow to the party, but after they're playing tennis or pickleball or golf or basketball, whatever they're doing with their buddies, and they missed out on this huge home run, then you come around to it. Unfortunately, the mass market tends to come around to it right at the wrong time. And
at the peak.
At the peak. And so they plow in in the public stock of Bird, and then they just like experience the downdraft. And then they're super sad and conservative and depressed. And so they're very conservative, and then they miss all the upside.
Right.
They're chronically like off cycle continuously.
Yeah.
I think there are different times in venture. What's really interesting about today is, there's not a lot of VCs that were in the business in 2001. There just aren't that many that are around. And most of them that are around are flying their private jets somewhere. They're not like me, still actually hustling. And the number of people that are trying to figure out, okay, how do we do this complicated pay to play? What is the legal authority to get it passed through the board and the shareholders? And how do we structure this? Just not a lot of people have done it before. And I think that there's it's our responsibility as directors in our portfolio companies and advisors to the startups we help need to not play into that mass market sort of mindset. So like, I think today is still completely risk off. I was in a board meeting yesterday talking about getting to cash flow viability, not because we want to stay there, but because it sort of gives you, your default alive. You're going to be alive no matter what. You keep growing at 30% a year without raising capital. And maybe the Fed will change things and the markets will open up, but maybe not. And that's not in our control. And if we can get to break even, now we have full flexibility of anything. We can always like raise money and go. That's not hard to do.
Right.
But if we don't make the decisions to get there today, then we're just going to be at the whim of someone we don't even know their phone number.
Right.
And so I think that's right. But there's going to be a shift sometime that Bullwhip will come back around. The beautiful thing about seed is we'll see it like populate through. We don't need to have a crystal ball. We can see the growth stage groups and later stage. I am frustrated because I have seen these cycles go, but I didn't sell enough in the last peak. Like I should have been selling some of my positions, and I was greedy. We should keep building. We're not ready to sell. We haven't achieved ABC strategic thing that would be really valuable. And
not recognizing that, the market has a say too.
Yeah.
Right. Yeah.
Yeah. So like
you're not some independent actor that just gets to do whatever you want in any market cycle.
Yeah. So just hypothetically, 2 years ago, I'm with a chairman of a company with, say, $25 million in revenue, and we could have sold the business, but we wanted to do A, B, C, and D to grow to just say 50 million.
Assuming that the market was going to stay where the market was at that time.
And so we have executed fairly well. The business has grown, but the multiples have collapsed, right? So we did a whole bunch of work and we destroyed value. And I'm on air talking about it because I think I need to not make that mistake again. I need to, when it's time to sell, I need to sell some assets that are ready to sell.
I'm seeing that happen with companies where they made a bunch of progress and they are raising at lower valuations due to lower multiples, no fault of their own.
Yeah.
Literally, they made progress. They have more revenue. They have a more robust product. They have more logos on their slide, and their valuation is down, not necessarily from where it was, but it's down from where they had projected it would be.
Yeah.
And in that respect, they kind of lost.
Yeah.
Yeah. They kind of lost because they just raised at the wrong moment.
Yeah. No, your portfolio is younger.
Yes.
So it may be that they didn't really have a choice to sell 18 months ago.
Oh, yeah. Yeah.
But I guess for the first time, I'm thinking about secondary markets because, there are board discussions where the company doesn't want to sell, And it might be that I think for my LPs, I do need to sell some of the position because just the valuations are super frothy.
Yeah, right. And you need to take some chips off the board.
Yeah. And I never had done that before. But I think both the secondary market is getting much more liquid, much more closer to fair market price. And I think the market is just much more volatile.
And it's becoming tech enabled.
Yes, right.
Yeah, we didn't really have secondary markets that were that tech enabled 10 years ago. But now
you had to know the person and just like call them and do it, which is not going to work.
Right.
Yeah. So anyway, I'm just trying to process through all that, but I think it's I think the world's getting more volatile over time and not less. So
all right, thanks for ripping with me, man. No, really. I mean, this is helpful because we're at the end of the year, and I'm obviously it's the time to process, right? It's the time to kind of say, what the hell do we think is going to happen in 2024, and specifically, how is it going to impact the work that we try to do, and the founders we try to help, and the LPs we try to generate returns for, right? And it's really dynamic.
Yeah, and for any listener, right, like, you can hold your portfolio for 20 years, and that's what we all were taught to do. But I think market timing is getting to be more attractive.
Yeah, it's getting to be more important.
Yeah. I used to think it was too hard. There were too many transaction costs, and you were going to time it incorrectly. And I still think there's a risk there, but the multiples are swinging incredibly fast.
It's crazy.
So I don't know if it makes sense just to buy and hold forever.
Yeah. All right, that's a good time for us to take a break. We'll let Doug share a little bit about Jumpstart Foundry, and then we will be back to dig into some stories on the healthcare and AI side.
Thanks, guys, for the opportunity to talk about our pre-seed fund, Jumpstart Foundry. My name is Doug Edwards, CEO of Jumpstart Health Investors, the parent company of Jumpstart Foundry. We're so excited to be able to talk about early stage venture investing, certainly the need for us to change the crazy world of healthcare in the United States. We are spending 20% of our GDP, north of $4 trillion a year on healthcare with suboptimal outcomes. Jumpstart Foundry exists to help us find and identify and invest in innovative companies that are going to make a difference in healthcare in our country. Every year, Jumpstart Foundry invests a fund, raises a fund, and deploys that across 30, 40, 50 assets every year, allowing ease of access for our limited partners to invest to help us make something better in healthcare. Some of the benefits of Jumpstart Foundry is there's no management fees. We deploy all the capital that's raised every year in the fund. We find the best and brightest, typically around single-digit percentage of companies that apply for funding from Jumpstart, and we invest in the most incredible, robust, innovative solutions and founders in the United States. Over the last 9 years, Jumpstart Foundry has invested in nearly 200 early-stage, pre-seed stage companies in the country. Through those most innovative solutions that Jumpstart Foundry invests in, we also provide great returns and a great experience for our limited partners. We partner with AngelList to administer the fund, making that ease of access not only with low minimums, but the ease of investing in venture much better. We all know that healthcare is broken. Everyone deserves better. Come alongside us with Jumpstart Foundry, invest in making the future of healthcare better, and make something better in healthcare. Thank you, guys. Now back to the show.
So you found this story on Wall Street Journal Pro Venture Capital about a startup called Orchid that is rolling out a genetic testing service for IVF. They raised $12 million. Just to kind of jump right to the point, this is a startup that is doing a little bit of what everyone had been concerned about as we continue to advance sort of the combination of both genomics as well as machine learning, which is starting to kind of give some predictions as to whether or not your offspring is going to be genetically predisposed to any particular diseases.
Yeah. That's why it's an important story. I think testing your offspring for all of these genetic diseases, and some that I think are chronic diseases, but I guess they do have markers for that. I think it's a slippery slope. Like, I don't know where it stops. And so, do not think we have any guidance or any idea where the regulators will stop it. So never mind other countries. Like, this is in the US. And so testing for, type 2 diabetes is the one that really caught my attention. So I don't know how you can test for type 2 diabetes. We were talking earlier, maybe there are markers or flags, or there are obesity genes. But I just think I don't know. It makes me nervous.
Yeah, it should. I mean, it's interesting that I think we're entering an era where we're going to have the rise of the ethics professionals. I think, because we got a lot of questions around how okay is this stuff. I mean, this thing is out in the wild. It's already operating. It's got $12 million it just raised. So it's happening. And I'm with you. I got real questions. Now, look, do I believe most people are going to be able to afford this in the near future? No. But technology, only the costs just come down. And if 23andMe can broadly, handle genomes for everybody in the country, I don't think this thing is that far. I mean, how different is this from Cologuard or, any of these kind of, test delivery things that you do for allergies or things like that? We just, put some blood in a box and send it off to the mail. So I think it is going to become more widely available. And just the idea that people are deciding potentially, it's not even like whether or not they're going to have offspring. It could be who they're going to be life partners with. I mean, the implications of this are really serious.
Yeah, and I think we're getting to, I like your idea about ethicists. We're getting to the point, I think we may be already at the point where the capabilities of our technology are not in question. Like, we have the capabilities to target offspring that are the tallest of their cohort, the smartest, the fastest runners, the whatever you want to select for. My view is that either now or very soon, we have that capability. The question is not, can we do this, which has limited human sort of advancements forever. It's, should we? And I don't know that you and I are the ones to answer that, but it makes me nervous that no one is really in charge of this. And this is in the US. I mean, who knows what people are doing in other unregulated countries?
Totally.
So, and then there's also a rich and poor divide, right? Like, if I have enough money to get this for my, I don't want any more kids, for my grandkids, then they're going to be able to do better in school, do whatever, some way better. And that's just not, I don't think it's good to society. It's not the American way. It's not good for the morale of everyone. It's just not good.
So we don't have any answers for this, but I think maybe one big takeaway I've been noticing as people are more hip to what's going on AI and they're using it more, they're seeing all the limitations of it, right? Mm-hmm. And that's good. That's good, because it's hard to be well educated on the space unless you've actually used it.
Yeah.
But I am starting to see a narrative develop where people are getting really locked into where the technology is today, right? Yeah. And using that to sort of extrapolate where it's going to be even next year. And
with the linear
curve? Correct, with the linear curve, right? I think we need to really move ourselves to a mind space where we just sort of come to terms with the fact that we are absolutely living in the future that we dreamt of and wrote about and made movies about and made cartoons about. Like, we're living in it now. And there ain't going to be a whole lot we're not able to do in our lifetimes.
Yes.
It's very clear to me that the floor where we're at today is going to yield science I can't even imagine, actually. Right? Science I can't even imagine. But I no longer have any sense of limitation. So you're right. it now all boils down to a lot of conversations around should we, a lot of conversations around thinking through the long-term implications of these things, thinking about the societal implications of things, thinking about ramifications that could happen to our biology as a result of these things. But it's not a question of whether or not we're going to do it. We should have been hip to it with the speed with which the mRNA vaccines were created. Like that, I think we were under such psychological duress that we didn't fully appreciate what had happened. I was just happy to
get out of the house.
Exactly. I don't think we fully appreciated what had happened there. But if you just look at the scientific achievements that have happened since then, you got to just stop with the limitation discussion, because it's just a roadmap from this point forward, right? But it is inevitable. Yeah. It's inevitable. We're going to be able to do all these things. We're going to be able to clone. We're going to, all the crazy, wacky things. We're going to be able to do these things.
Yeah. And people need leaders to lead them in the most productive, most fruitful, most fulfilling direction for the most people in the society. And I'm pretty fearful that we don't have leaders that do that. We have leaders often that are taking polls of what the society wants today and then sort of trying to give them that in sound bites, and just makes me worried. But I guess the only way to think about this where I can feel like I have some frame of reference is the internet or something else that happened that was significantly different, that we all lived through. And I think when the internet first came out, it was a pretty poor replacement for existing media, right? So I don't know, it was like a magazine that was super slow and a pain in the ass. And a lot of people in 95, 96, 97 took that view, like the tech sucks. And this I read this Economist in my hand. And why do I want that?
There's the video clip of David Letterman, making fun of email. Yeah. It's great. Yeah. You should look up on YouTube. There's a clip of him making fun of, I think he was interviewing Bill Gates. Okay, yeah. And he was talking about email. Yeah. And he was like, so it's like a letter. And like the whole audience laughs, blah, 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 blah. Yeah. And now David Letterman's show is on Netflix. Yeah. Right? Yeah. You know what I mean? Like that's the...
Yeah, so I think the question is not apples to apples. Does the tech today replace the old tech? Right. It's what's the rate of change, and then the real thing that you sort of talked about that I think is the game changer is that we don't use the internet for magazine publishing. Like that's just what the early people that didn't know how to use these tools. That was the first thing that they thought of because it was the easiest, like, adjacent space. And I think we're seeing that AI right now. That like people are using it for the kind of a fun thing to play with in a space that they're already doing this job. And in some ways it's better, in some ways it's kind of worse. But the rate of change is dramatic. And what I think I want to talk about with you is that it's not that. It's what is the new use case. Like, it's not a new letter, it's Netflix. Or it's like Amazon. I almost never drive to the store to buy something now. I don't know. Amazon does that for me. And so we can't really conceive of how these tools will be used because we don't know what their features are. They're growing so quickly. It's going to be just going to be a different experience. And so saying it's not as good at writing this poem is not really the point, I don't think.
And actually this conversation returns me to my bullish position about venture capital, because the reality, and this is the reason why I got into venture capital in the first place, because I came into this space as a technologist and an entrepreneur. But once I learned about it, I realized that venture capital is where all the innovation happens. That's it. Now venture capital is changing.
It's our job to translate it.
Yeah, but venture capital is changing, right? I mean, you have crypto, and there's a bunch of innovation happening in that space. So the formats of venture capital are changing, but the reality is It's capital that is investing in innovation that is changing the world. And that's not stopping. That's not stopping. And so that's probably the fundamental bullish case for venture, regardless of economic cycles, Fed monetary policy, all those other kind of things. The reality is that science and technology is going to continue to radically change our world. And how that technology is going to get funded to do that is venture capital. That's it. It's not going to happen in academia.
No.
It's not going to happen in incumbent corporations.
No, listen, someone has to understand what the founders are saying, just literally understand what they are talking about. And the incumbents typically have a natural tendency to not understand or want to know because it's going to change their career path. And then provide capital, but also provide advice on like how to bring this thing to the world. That's the job that I love to do. And I think that never is going to disappear. Now, the form it happens, whether we're structured as an LP structure and how it all works out, that can all change. But that sort of a process of understanding that this team is really doing something that's game-changing and the market is ready to adopt it, and then sort of funding them, but more importantly, like guiding them through the process, bringing them to hospital A versus hospital B, because A will do the pilot and experiment, and B wants to wait till it's fully ready. I'm very bullish on innovation continuing to change the way the world works, and VCs have to be part of that. Now, in healthcare, and this story reminds me of it, it's someone's life at stake, and it is our future generations. And how are we going to manage the way that we procreate? It used to be, you got married and you settled down, and then nature happened and you had kids. And now that is maybe not how it works anymore. But the culture and the society, I think there was a reason for family and community, and all these things have benefits that we've taken away from society. And I think it has a lot of negative consequences.
Let's shift to our next story. Kroger, they are shifting some of their little clinics to be totally focused on senior care. Now, we are going to talk a little bit more about what's happening broadly in MA with Cigna and Humana here in a second, but this seems like just a totally smart play, because I don't know about you, but I can tell you, like, of all the places that my mom goes on a weekly basis, she's definitely in the grocery store. And she also kind of likes going to the doctor.
Yeah.
So if you can kind of bundle that in a lot of communities, especially where there's inadequate, PCPs, seems like a winning proposition to me.
Yeah, I think it makes a lot of sense. I think focus and building out an urgent, this is really an urgent care thing.
Yeah.
Urgent care is now maturing where I think you almost have to have a niche of the market that you're catering to. So a friend of mine's in Philly, he has a urgent care that is really only for 20-year-olds that don't need a lot of health care, and they want a kind of a hip, kind of crazy colors and very tech-enabled sort of experience.
Yep.
And I think he's been able to focus on that and really kind of pay attention to it. I was in Dallas 2 weeks ago, I guess. I met a guy who has a pediatrics urgent care. That's all he does. Because if you have a 1-year-old at, Saturday night at 10 p.m. and you realize he ate something or fell or whatever, you need kind of specialized care. I think we're seeing a kind of a segmentation piece, and I think it makes a lot of sense for Kroger to focus on this space because they're already, I think you're exactly right, they're already in the store, and it's a good population group.
Yeah, and we know that Kroger has a ton of data on their customers,
Yeah.
if they can match up that they've been working on health scores and tracking,
Yeah.
what aisles their customers spend a lot of time in. We haven't heard a lot from them on this front, but they've been building this database and these algorithms for a long time now, probably more than a decade. So
we have a friend. We should call Mark and try to talk to him.
We should, yeah. But when you combine all that data, right?
Yeah.
It positions you pretty well to be able to execute value-based care, and perhaps they're looking and saying, we think we can clean up an MA, right? I mean,
yeah, I don't know if they underwrite risk at all right now, but
no, but I'm just saying
they could be a really good partner. And then listen, most of chronic disease will have some diet component.
Yeah.
So being able to just walk right out into the produce section and say, hey, why don't you consider this? Or let me show you these different kinds of soup that are better and they taste just as good. Like that hands-on thing is much better than a printed off flyer that I'm not going to remember to bring into the store. And if I do, I can't even figure out which can of soup they want me to get.
Right.
I think it could be really powerful.
Yeah. I mean, they could go and they could partner with health systems that are doing MA and be sort of a continuous partner.
Yeah.
Touch points, data collection, things of that nature.
Yeah. Humana has it's a brand in urgent care. I can't think of the name. Center something.
Is it Centerwell?
Yeah, Centerwell. That's right.
Yeah.
They're sort of designed like this. It's because of their MA business,
right?
But they don't say they cater to older Americans, but I think mostly
they definitely
do.
Yeah.
All
right, so let's shift to Cigna and Humana. So lots of discussion. We did a whole a whole episode talking about Cigna and Humana, and already the deal's off.
Yeah. Sorry for that false alarm. We're out.
Yeah. Instead, we're going to buy our stock.
Right. Yeah. I mean, I'm excited to dig into Medicare Advantage next week with Emily because it's a huge space and super complicated. But I think the answer was the stockholders, they want share buybacks. They wanted to have a return in 90 days,
right?
60 days.
Right.
And anything that's long-term, they just can't focus that far out. And I don't know. I still feel like it was a good combination over a 2, 3, 5-year view. But I don't know. All the institutional public stock groups, I mean, Cigna stock lost a lot of value and then they came back and now they're back again. I mean, they took it away and now it's back again. They will probably, I mean, if you buy, I think it's $10 billion that they're planning to get for the HealthSpring thing. If they use all that to buy stock, it's going to buy a lot of stock. It'll prop up the stock.
That's right.
But I don't know that it is a long-term strategy.
No, it's not a long-term strategy, but they are very, very strong in the commercial space.
Yeah.
And their shareholders are probably saying, you just stay good in the commercial space.
Yeah.
And you weren't good at MA before. What makes you think merging with Humana is going to make you that much better? There probably was a little bit of that going on. So anyway, it definitely feels like a Wall Street didn't allow it kind of thing.
Yeah.
I think we've seen these kind of things.
I mean,
you remember when we watched what was it? Healthways and Weight Watchers.
Yeah.
What wasn't it? Was it? No, it was Nutrisystem. It was Nutrisystem.
Yes.
Yeah. The whole Tivity Health thing, and we watched them try to pull that off, and that was.
As soon as you get on the wrong side of Wall Street momentum, it's just hard.
I mean, they didn't even have a chance to try to make it work.
Yeah.
It was just like, no, this is a disaster. So,
and I think that's why. I mean, that's one of the arguments for private equity. Like, get off the public markets, not the 90-day cycle, in the limelight all the time. Everything you do is announced, and then take your strategic actions over the next 2, 3, 4 years with us, and then we'll bring it back public once it's pretty again. I think that's pretty compelling.
Yeah,
so
agree. All right, and just kind of wrapping up here, Humana was yet another company that was there have been several payers that are getting called out, mostly because the providers are all upset about their claims getting denied. But where is AI most prominently being used in healthcare today? It's being used in claims adjudication. It's being used to determine whether or not we're gonna pay for a claim or not. We're not using humans for that anymore. We're using AI.
Yeah, I mean, it was a hard week for Humana, right? The deal got called off, and then they got this lawsuit. I mean, the lawsuit kind of confused me. I mean, they certainly are using AI to review claims.
Of course.
I mean, there's no question about that.
Of course.
But it's not clear to me that is in violation of anything. And I think you're right. Providers are upset about it.
Yes.
And what they should do is get their act together and use AI on their side. That's what has to happen. But there's been several suits. Humana's on the list now. I think it just means that they denied a lot of claims. And I think the strategy that is frustrating for providers is they can deny many more claims than you can possibly appeal.
Yes, exactly.
And so, you have to buy your own arms. It's an arms race. You need to get your own AI.
It is an arms race. Yeah, you're gonna have to have your own automation and fight back with that. Okay, final thing I want to talk about on the AI side, man. I just love the Empire Strikes Back version of Google in the AI world. I've the whole time I've been pretty long Google on the AI stuff. I just feel like they started all this with DeepMind, and they were definitely in the do no evil sort of mindset, and so
they invented the Transformers.
Totally.
So,
yeah.
they created the technology that has created ChatGPT. I think Google invented and then open sourced because they are kind. So they've been laying back. They have a lot of talent, a lot of big brains there.
But this whole open AI thing has got them going, and they have leveraged this setback that OpenAI has experienced with the board firing Sam Altman, then him coming back, and all the uncertainty there with Microsoft, and it's a nonprofit. Can we trust this company? Blah blah blah. They've leveraged that to roll out so much stuff in the AI world. They rolled out Gemini. They've incorporated Gemini into Bard. They've incorporated Gemini into Google Cloud Platform. And now they're rolling out new versions of their models, a specific version called MedLM that is being used by HCA already. Dr. Mike Schlosser, another person we should try to get on the show, is testing it out in various pilots right now.
Yeah. So
and they're pairing it with Augmetics, right?
That's right.
The ambient listening technology. So they're basically cutting down their scribing by 60%, right? In the EMR records, isn't that right?
That's probably right. I don't know the quote, but I'm sure you're right. The this is a specific language model called MedLM and has a longer name. I've seen scientific papers last summer where it's specifically trained on medical research, clinical research, all of the aspects that are, very acronym intensive, lots of, Latin words for different diseases. That's what it trained on. And it's, I think it's going to be really powerful as they come into the healthcare space. And then Augmetics is better for the kind of processing how the offices it went. Okay. Who was interacting? What were you looking at? Make sure you check on this thing. And so it's a great pairing because I don't think they are really focused on the clinical side.
Right.
And so it makes sense that HCA would bring HCA is bringing the best of different models and putting it together. So it's interesting.
Yeah. I mean, it still will hallucinate. I read an article, Dr. Schlosser said it hallucinates. Yeah. So we're not past that, right? That's still just a fundamental limitation of all this large language model technology is it hallucinates. So that means it cannot be trusted 100% to do any of this stuff, right?
It's a predictive model.
Yeah.
So
it's predicting.
Hallucination is the easiest way to understand it.
Yeah.
But even if you're at, 5 nines reliability, there's still going to be once in a while that it doesn't predict the right thing. And we have to account for that by putting like duplicate checkpoints or different things in when we're in a medical setting.
Yeah. And also we don't necessarily know how to interact with it yet.
Yeah.
We have eons of time where we know how to interact with each other as humans. Right. We don't know how to interact with this thing yet. So,
I mean, for instance, it doesn't have body language.
Right. Exactly.
There's no, even if you give it a voice, there's no real tone of voice interaction that it's not sort of making up. So you lose a lot of the value that humans are used to processing, and we have to learn to deal with that.
Exactly. So anyway, keep your eyes on Google in the AI space. If you have not been tracking all the stuff that they've rolled out, they're not necessarily ahead of OpenAI. I would say everybody is sort of a little bit running their own race and trying to just show that they have competency in the AI space. But what everyone needs to understand is Google has a ton of competency in this space. They have the people, they have the underground network and cloud to be able to pull it off. They built their own GPU chips, and they've been in the space for more than a decade at this point. So this is definitely a space they are going to take very, very seriously.
Yeah, and when you think about training these models, right, like access to data is going to be a really important piece, and YouTube is just a huge ocean of humans doing everything under the sun, and it's multimedia, right? So they have the transcripts, but they also have everything else,
ridiculous data.
And so I think they're starting to teach the machines how to do things by showing it a video of here's how you do this procedure. So, I mean, Google has a lot of assets to sort of work on. So,
yeah. All right. Good rundown. Anything else you want to talk about?
No, we'll be diving deep into Medicare Advantage next week.
Yep. Looking forward to it. Talk to you then.
All right.